Thinking about buying a business? It's a bold move, one that can accelerate your growth or make you stumble if you're not fully prepared. Hi, I'm Rita Kasparian, Director Growth and Transition Capital at BDC. For the past 24 years, I've been supporting entrepreneurs throughout their acquisition projects. Here are 10 essential questions to ask yourself before you move ahead with an acquisition. Let's start with the benefits of buying a business. First, you're not starting from scratch, so you avoid many headaches linked to launching a new division or expanding organically. Products or services are already in place. No need to hire a full team or buy new equipment right away, and the customer base already exists. An acquisition can help you scale faster, diversify your offer, or gain ground on your competitors. It can also be an effective way to enter an industry or market where startup costs are high. But be careful, it doesn't come wrapped in a bow. You need to know exactly what you're buying, and that starts with asking the right questions. Question number 1, does the acquisition make sense? Ideally, the decision to buy a business should come from your strategic planning process. This helps you determine whether acquiring a business is the right move. Don't buy a business just because you can. Ask yourself, is it more advantageous and less costly than growing organically? Will it help you gain market share? Will it give you competitive advantage? Will it increase the value of your business? Your acquisition should bring clear advantages and tangible value to your growth plan. For example, a vertical integration that reduces your supply costs and increases your margins. Question number 2, what impact will it have on your business? Acquisitions are exciting, but they can disrupt your finances and operations. For example, a small business buying a larger one may end up with a structure that's too heavy to manage, leading to unexpected costs and internal tensions. These changes can quickly become overwhelming. To stay on track, you need an acquisition and integration plan, a roadmap that outlines everything that must happen before, during, and after the transaction to ensure a smooth integration. This plan helps maintain business continuity, achieve synergies, retain key talent, and minimize risks, so the acquisition truly creates value. Question number 3, what are the objectives of your acquisition? Before you move forward, get clear on your objectives, your timeline and budget, team roles, who is responsible for each step internally and externally, the type of business you're targeting, size, location, market, etc., the risks you're willing to take. Clear objectives will help you communicate your intentions and avoid wasting time on deals that don't fit. Question number 4, how do you find a business to buy? Owners who want to sell don't usually advertise it openly. This is where your network becomes extremely valuable. Talk to people in your circle, family members, colleagues, your lawyer, accountant, or banker. They might point you to interesting opportunities. Speak with people who've already completed acquisitions and learn from their experience. They can guide you toward the right resources. You can also reach out to business brokers who manage portfolios of businesses for sale and explore specialized websites. This market is very fragmented, and it often takes multiple conversations to find the right target. Question number 5, what is the value of the business you want to buy? Setting a fair price for a business isn't easy. You'll need access to key information. The most common valuation method is to use EBITDA, earnings before interest, taxes, depreciation, and amortization. It measures a business's ability to generate profit from its core operations. We even have a video on the topic, and we invite you to watch it to learn more. You'll find the link in the description. In practice, a multiple is applied to EBITDA. The multiple varies depending on factors like the industry and market conditions, but some tech companies are valued using a revenue multiple instead. If EBITDA is negative, valuation may rely on assessing the assets separately: inventory, accounts receivable, client lists, etc. Sometimes, a business is worth more in pieces than as a whole. For example, you may choose to purchase only the real estate portfolio instead of the entire business. Given the complexity of the process, it's often useful to hire a professional valuator to determine a fair price. Question number 6. How will you finance the acquisition? Negotiating the right financing structure is essential to a successful deal. It typically includes a mix of equity, your investment or down payment, senior debt, seller financing, also known as a vendor note or vendor takeback, and sometimes mezzanine financing. Equity is the money you invest directly. There's no universal rule when it comes to financing structure. It's a case-by-case situation. The down payment can vary widely depending on several factors. Can your existing business leverage financing to cover a large portion of the acquisition? For a first acquisition by an individual, the expected down payment is usually around 20 to 30% of the purchase price. However, if a key employee is involved and brings significant value, that amount can be reduced. Equity reduces the amount you need to borrow and shows lenders you're committed to the success of the acquisition. Senior debt is a loan secured by business assets. Generally, this type of loan has the most restrictive repayment terms, including the requirement to be repaid over a determined period. You will very likely need to make monthly payments and meet other conditions. The seller financing, also called a vendor note or vendor takeback, is the seller's commitment to defer a portion of the payment to a later date, which helps reduce the pressure on the business's working capital and ensures its long-term viability. This type of financing usually comes with a reasonable interest rate, lower than traditional lenders, and flexible terms. The mezzanine financing or junior debt helps cover the gap between the purchase price and other sources of financing. It involves higher risk from the lender compared to senior debt, which means higher interest rates, but it also offers very flexible repayment terms. Question number 7. Do you really know what you're buying? Appearances can be misleading. A business may have legal issues or financial statements that don't reflect reality. To avoid unpleasant surprises, invest in a solid due diligence process. It will help you better understand what you're buying and ensure you're paying the right price. Due diligence is an analysis conducted by a buyer before finalizing the acquisition of a business. It covers all critical aspects of the company: finances, tax, legal, operations, HR, environment, IT, contracts, risks, and more. Experts can help you carry out this process, and the costs vary depending on your needs. Question number 8. What is the company culture like? Pay close attention to management style and team dynamics. Check whether the business's culture aligns with your values and whether changes will be needed. But remember, change can create resistance from employees, suppliers, or partners. You need to communicate clearly and address the concerns of all stakeholders. Many failed integrations stem from overlooking the human factor. Assessing the business's culture will give you insight into HR challenges and needs. There are tools and professionals who can assess organizational culture. These resources also evaluate leaders in a psychological context to better understand their management styles. Question number 9. Is the business compatible with your current operations? Make sure there is real synergy between the two businesses. An acquisition only creates value if both businesses can truly complement one another and operate more efficiently together than they would on their own. For example, a transportation business buys a logistics firm. The synergies are immediate: optimized routes, lower costs, and better market coverage. Synergies require complementary products or services, compatible marketing and sales approaches, production and distribution methods that can be harmonized. And don't forget, plan the integration of teams and manage overlapping roles, which leads to the final question. Question number 10. How will you integrate the new business into yours? You've bought a business. Congratulations! Now, you need to operate it alongside your existing one. One of the first steps, sometimes even before closing the deal, is to form a joint integration team from both management groups. This team is responsible for creating and executing an integration plan to achieve operational goals. Another important step is to assess what needs to be integrated and how to do it. For example, if both businesses use different accounting systems, you'll need to choose which one to keep and who will lead the integration. The team also needs to understand how these decisions will affect the business's other departments. You'll want to communicate the plan clearly to employees, customers, and suppliers. And above all, protect customer relationships. If changes are coming, reach out early, call or meet with them directly. Let's recap the common mistakes to avoid during the process. Skipping proper due diligence, buying for the wrong reasons, overlooking organizational culture, neglecting the post-acquisition phase, waiting too long before talking to your bank. There are also unexpected elements to plan for when buying a business. The process can take a long time, sometimes over a year. Issues may arise, seller involvement, cultural fit. Debt will increase and profits may dip at first. In short, expect the unexpected. But with the right tools and resources, the process becomes much simpler. You can rely on BDC's expertise. Our advisors support you at every stage of the acquisition process and offer financing solutions specifically designed for buying a business. We also offer free practical resources, including a complete toolbox, business plan templates, guides on valuation and financing. You can find everything on bdc.ca. And don't forget to check out our Insiders Look videos on buying a business, featuring entrepreneurs and their real-world experiences. Buying a business is an exciting journey, but it requires preparation. Ask yourself the right questions, surround yourself with the right experts, and use the tools available to you. Have questions or comments? Leave them below. And don't forget to like, share, and subscribe. See you soon for another episode of Ask an Expert.